break it down now with Jeremy Siegel, finance professor at the University of Pennsylvania's Wharton School. He called the market low in March 2009. Last July, he told us the market slide and stocks would soon reverse. By late August, a new rally had begun, and we're there, even though we see kind of a breather day in stocks here, Jeremy. Is it all about earnings, or is it QE2 and the stimulus? I mean, what's driving us here?
Yeah, all the above, Matt. I mean, keep your eyes on earnings. The street thinks that S&P is going to earn $94 a share, which means we're selling around 13.5 in a low interest rate environment. That is a very, very good price ratio, and I think investors know it.
Bring in Matt Zeman at the CME Group in Chicago. Matt's a trader with LaSalle Futures Group, and also, of course, still with us is Jeremy Siegel. But, Matt, what's your take on the trade? Matt was saying kind of a little bit of a boring day today, right?
Well, at least in the markets, it seems a little bit boring, but I'm sure you're all psyched up for what's to come.
Absolutely. Today a little bit choppy, a little bit boring, but, everybody's looking ahead to Intel. Certainly today's jobless claims, not a good number. We'd like to see that number under 400K and holding under there. So I think you've got a little bit of reluctance, and frankly, we like the market kind of scratching and clawing its way higher, but we would like to see more of a pullback at this point. So a little bit of pullback wouldn't necessarily be a bad thing.
Hey, it's Dominic here. One of the quick questions I have here, we kind of noted here that Intel put option trading is at the highest level in a year. The two most active options today, the January, that's this month, puts at $20 and $21. What does that say about what people are expecting out of Intel for the close today here?
Well, I don't think people clearly don't have a whole lot of faith in these numbers that are going to come out today. And, I'm not a stock guy. I don't trade Intel personally, but I think there's a lot of skepticism. It appears that the bar for earnings has been set relatively high, and I think people are bracing for a little bit of disappointment, actually, at this point.
All right, so bracing for disappointment, waiting for a little bit of a pullback. Jeremy, do you agree? I mean, you always hear that it'd be healthy to have a little bit of a correction. Do you think we need to see that?
Well, when everyone waits for a correction to buy, you're not going to have one. That's one of the primary rules of the market. So people waiting for that pullback, the more people that wait, the less I think it's going to happen. I think we need much more disappointing news than just 1 week of jobless claims to derail this particular bull move that we have now.
Speaking of rally, commodities obviously have been on a tear lately. And Adam, investor Jimmy Rogers out with some commodity forecasts. Does he expect any pullbacks there?
Well, I'll tell you what, he says he would rather own rice right now than gold. And I got to show you the gold chart, because I know we talk about gold a lot, but it's at what you call effectively a triple top. It's gone up to the same spot, called around 1,400, 3 times over the past couple of months. Each time it's gotten a little bit through, but it just can't seem to hold on. Take a look at it. 1, 2, 3. There are those 3 spots you see on the far right side. It's now come off. So, Professor Siegel, I guess I got to toss this one out to you. Jimmy Rogers is saying sell gold. It's probably going lower. It may ultimately go to 2,000, but he says it's going lower in the near term. You're always the one to go out there and make predictions. What do you think about gold here?
Well, first of all, for Jimmy Rogers to say gold is going lower because he's a big commodities man, wow, probably bears some listening. Gold does look toppy. I mean, short run, it's always hard to predict. I still think that 5 years from now, people who buy gold today are going to be disappointed in the returns. They're expecting either hyperinflation, financial crisis, world falling apart. I don't think any of that's happening, and I think that there'll be some disappointing returns.
Speaking of returns, we did also talk to Gary Schilling earlier here on Bloomberg, and he kind of gave his advice. He's often very cautious about the outlook. Here's what he said, though, investors should be doing right now.
Well, stocks have got a lot of momentum behind them, and maybe the earnings will come through to justify them. But I think there is reason for caution. I wouldn't say we're in a frothy stage of the stock market, but it certainly has come a long way since March of 2009. And you're getting to the point now, like commodities. I think commodities are clearly in a bubble. Stocks aren't there yet, but we could be if things keep up at this rate.
So, Jeremy, we hear Gary Schilling what his outlook is here. We know you still think stocks are going to be up about 10 to 15% this year. But any words of caution here? Do you see any kind of pullbacks at any point?
Well, yeah, I know Gary he's a good friend of mine. He's a big bond man. For him even to give a little nod, the stocks might still go up, I think is favorable. I mean, I think the two things are, first of all, more euro crisis. I don't think we're over with that, and perhaps a muni crisis. Those are short run, though. I don't think they're going to derail the main drivers of the bull market, which are the earnings on the S&P 500 and continued low interest rates. I mean, those are the major factors. So we're always going to have those threats. We're always going to have some short run disturbances one way or the other. But I think the bull move is still definitely there in the stocks.
I mean, Jeremy, you're comfortable saying that the muni disturbances and anything that happens in Europe, that they'll just be short disturbances, not big deals? You're really comfortable saying that?
Well, there's actually, I read the number of defaults is actually slightly going down. Of course, we look at Illinois, we look at California. Sometimes I think they need a crisis for the feds to come in and really say, okay, guys, if you don't take these cuts, and these cuts, and these cuts, we're going to walk away and we won't help you. Sometimes you need the bad cops in there to make the cuts that are necessary at the state and local level to get these budgets back in balance.
Hey, Jeremy.
I think it's going to happen, so I don't think they're going to let California go down.
Hey, Jeremy, it's Julie here. Speaking of low interest rates, which you mentioned a minute ago, the last time or a couple times ago you were on, you mentioned that you think quantitative easing could end perhaps as early as the summer. I mean, isn't that a risk for stocks as well? Because you sort of have to have the economy encouraging investors enough by the time the Fed is pulling away QE2.
Yeah, I'm often asked that question, because I do think interest rates are going to start increasing by the summer, and I think the Fed might even start raising the Fed funds rate at that level, and people say, Jeremy, isn't that bad for stocks? If you look at history in the early stages, no, it is not bad for stocks, and the reason is because it's strength of the economy. They are only going to, terminate QE2 and start raising rates if our economic growth is 4% or higher. I think we're going to get 4% growth, believe it or not, GDP-wise, in 2011, and that's good for earnings, and that's going to offset any interest rate move that the Fed may make.
Hey, Matt, it's Dominic here. Speaking of other types of government intervention, obviously the ECB somewhat active in buying up bonds in Europe as well, putting cash in the system. What's going to happen here? We saw some pretty decent numbers in bond auctions from Portugal, Spain, Italy. Is this a turning point, or is the trend still higher here, and we could see more damage down the line?
I think we could actually see more damage. Don't forget, we've seen this song and dance before, starting with Greece back in April. And, right now the market's done a very good job once again of kind of sweeping the whole thing underneath the rug. Obviously, the Japanese pledge to continue buying debt was a big help, but I don't think this is a problem that's going to go away anytime soon. I personally believe that the euro system, the structure is flawed, and this is something that I think we're going to see flare up again here in the not too distant future. So I think there's more pain to come.
Hey, Professor Siegel, let me follow up on that concept, and that is simply this. Yeah. If you make the argument that the yuan is effectively loosely pegged to the dollar, and of course the Chinese were buying some of the European bonds yesterday, might they be buying those bonds to support the euro, which in theory weakens the dollar and just makes Chinese goods more expensive or more attractive?
Well, first of all, I agree. I think the euro is in trouble. I think the peripheral countries, this is just, a better auction is going to be one day. There's going to be a worse auction another day. And then I was reading today that Germany's GDP increased at the best in many years. It's actually even slightly surpassed the United States in recovery. The core is still doing well. The export oriented firms are doing extremely well with their earnings. A weak euro is not necessarily going to be bad for a lot of European firms, and Americans can now buy those at a 20% discount. You see 8, 9, 10 PE ratios in that European market. As far as the dollar is concerned, if the Chinese have, they may want to try to support the euro, but listen, they're worried about preservation on their wealth. The dollar looks better than the euro, I think, for that goal.
Hey, Jeremy, I want to bring it back home because I know you are a proponent of QE2, or at least you think it's been working well here, and the stimulus as well. You think the economy is expanding at a better pace. Art Laffer wrote an op-ed in the Wall Street Journal today saying that we should be cutting back on government spending as a percentage of GDP, and he showed a couple of examples where that actually helped boost growth. What do you think about that concept, cutting back on federal spending, boosting growth?
I don't like big government. I think the private sector is more efficient. I think we're giving too many handouts here and there and subsidizing too many things here or there. That's a long-term reform that we really should pursue. In the short run, I really like the tax cuts that Obama, enacted. I mean, they even went beyond my expectation. That combined with QE2 is a double dose that I think is really going to push our economy forward this year.
All right, Jeremy Siegel from Wharton, thank you so much for joining us. Also, Matt Zeman there from LaSalle Futures. We take a quick